All right, let's dive into one of the biggest debates in investing right now, gold versus stocks. With everything going on in the markets, who's the real winner here? Let's figure it out. So, you've probably seen the headlines, right? The stock market is just soaring. At the same time, gold is smashing all-time highs. It seems like everybody's portfolio is winning. But wait a minute, can that really be true? What if one of these is telling a completely different story about where our economy is headed? Okay, let's just look at the raw numbers. Over the last 5 years, the S&P 500 is up an awesome 88%. That's great. But then you look at gold, and whoa, it's up a staggering 180%. That is more than double the return of the stock market. Something's going on here that isn't immediately obvious. And here is the absolute key to understanding this whole thing. The problem isn't with stocks. It's with the ruler we're using to measure them, the US dollar. You see, when we say the market is up, we just mean it's up in dollars. But what happens if that dollar itself is shrinking? So that brings us to our first big idea, gold's winning scorecard. To really get what's happening, we have to look past the dollar and find a better, more stable way to measure our wealth. It's time for a whole new way of keeping score. So let's try a different measuring stick. It's called the S&P 500 to gold ratio. It sounds a little technical, but the idea is actually super simple. Instead of asking how many dollars it takes to buy the market, we ask how many ounces of gold does it take. This gives us a much, much clearer picture of an asset's real value. And check this out. This is where it gets really mind-blowing. If you go back to the year 2000, right at the peak of the dot-com bubble, you would have needed 45 ounces of gold to buy the S&P 500. 45. But today, you only need 1.4 ounces. So when priced in gold, the stock market has gotten incredibly cheaper. Yeah, let that really sink in for a second. Your stock portfolio, it might look bigger in dollar terms, but your actual ability to buy a real tangible asset like gold has gone down. In other words, you've actually lost purchasing power. So how in the world did our financial measuring stick, the dollar, get so, well, broken? To get that answer, we've got to go back in time a little bit. Let's get into the story of the dollar. This slide shows us probably the most important single moment in modern financial history, August 15th, 1971. Before that day, the US dollar was literally backed by physical gold. But on that day, President Nixon went on TV and just severed the link. He cut the cord, and in an instant, the dollar was on its own. It became what's known as a fiat currency. So, what the heck is a fiat currency? Well, it's just money that isn't backed by anything physical. It's not backed by gold or silver or anything. Its value comes completely from the faith and trust we all have in the government that prints it. It's basically a government IOU. And here's the direct result of that change. It's a pretty simple three-step process. First, central banks can now basically create money from thin air. Second, you get all these new dollars flooding the system, chasing the same amount of stuff to buy. And third, the inevitable result, inflation. And that just chips away at the value of every single dollar in your wallet. This all leads to a really big question. Is this situation we're in totally new? Well, as we're about to see with history's economic alarms, the answer is a big, fat no. This pattern is not new at all. Just take a look at the last 100 years or so. There have only been a handful of times when gold has dramatically outperformed stocks. The early 1930s, the 1970s, the year 2000, 2008, and 2020. What do they all have in common? Every single one of them was followed by a major economic crisis. And now, we're seeing that exact same pattern playing out again. Kind of makes you think, doesn't it? And, it's not just regular investors paying attention. The big players, I'm talking about entire countries, central banks in places like China, Poland, and Turkey, they are buying up physical gold at a breakneck pace. They see the writing on the wall, and they are moving away from the dollar. Okay, so we've laid out the problem. But the real question is, what does this mean for you and your money? In our last section here, the Real Diversification Plan, let's talk about how you can actually prepare for what might be just around the corner. This quote right here, it just hits the nail on the head. We all saw this happen recently, right? Governments can print trillions of dollars for stimulus, but they can't print real wealth, they can't print more factories or more houses. All that new money just ends up devaluing the savings of everyday people like us. So we have to rethink what diversification actually means. A lot of people think, oh, I'm diversified. I own different stocks, some tech, some AI, some blue chips. But that's not real diversification. Real diversification is about owning completely different types of assets, things that are going to behave differently when an economic storm hits. A truly resilient portfolio is all about balance. Of course, you want paper assets like stocks for growth. You also want hard assets like real estate for stability. And then you need an insurance policy, like physical gold, to protect you when currencies get shaky. You might even have a small piece in speculative assets like crypto. The key is to be prepared for anything. And really, that's what this all boils down to. The warning signs from history are pretty clear. Our financial rulers seems to be broken, and the big central banks are already making their moves. So, the only question that's left is this. When the next economic storm finally hits, is your portfolio going to be ready for it?